As David mentioned tonight, I'm going to go over what happened last year in the markets. I'm going to talk about what we can see for this year and beyond. And specifically, I think there are three scenarios we're looking at, and I'm going to explain them with only two economic variables, jobs and inflation, and I'm only going to use 100 slides to do it. And then I'm going to add a few wild cards that we think could alter that forecast, and finally going to follow up with what I call the $64,000 question, which is what does that mean for your portfolio? So let's look at the markets. Last year, this is the Toronto Stock Exchange. It was up 13%, a decent return overall. And so far this year, it's up just over 5%, so even better returns so far this year. Now, if we were to break that out and look at the different sector weights in the Toronto Stock Exchange, you can see that really three sectors comprise 75% of the entire market: financials, energy, and materials. Now, unfortunately for us, those three sectors are not where we saw the returns, because the returns, if you had healthcare and technology, did very well. But the three heavily weighted sectors actually performed moderately poorly. And in fact, in materials, it was actually down, and that was mainly gold. So you saw a concentration of where the performance was not where we would want to see it in the Canadian equity markets. Looking at the U.S. markets, this is the S&P 500. Last year was up over 30%, 32.4%, extremely strong return, and it was very low volatility. It was basically up in a straight line all year. Not as good so far this year, up just over around 2%, but still pretty decent returns. If we break the sectors out for the U.S. markets, you can see it's a much more diversified market. You don't see those heavy weights in one sector, but even better, it's the opposite of what we saw in the Canadian market. Mainly, the sectors that actually didn't perform that well were the sectors where you had a very low weight. So that's one of the reasons why you saw such a strong return in the U.S. markets. Now, looking at the bond market, the yellow line is 10-year U.S. yields. The white line is Canadian 10-year yields. I'd point out the green line, it's at 2%. Anytime you get below 2%, it's indicating the markets are under a lot of stress. And we've seen yields move well beyond that 2%, indicating the economies in North America are actually recovering. Now, the other thing I'd point out in this is that U.S. 10-year yields are now higher than what we see in Canada. And that's an indication of a stronger U.S. economy relative to the Canadian economy. And I'm going to explain a little later on why we see that. Now, as we saw earlier in the year, starting in about May, yields started to move up. And the cause of this is the U.S. Federal Reserve started to talk about tapering their quantitative easing program. Now, what quantitative easing is the U.S. Federal Reserve creates money, and they use that money to buy back U.S. treasuries in the open market. And presently, at this time, when they started about tapering, they were buying it back about $85 billion in mortgages and treasuries a month, a very large amount. So what that does, when you're buying that amount of treasuries and mortgages, it tends to drive yields down. So the talk of them tapering led to the yields to gravitate higher. Now, what happened in around September, everyone expected them to finally announce this tapering, and they didn't. And it was a surprise for the market, and we saw yields move down. Finally, in December, they announced the first tapering of 10 million, and with expectations that they would continue throughout this year. And presently, right now, they're only buying back $55 billion a month. And that's one of the reasons why we've seen yields move higher. So when you look at this, you can see that quantitative easing had a big impact on the bond market last year. But actually, it also had, I would maintain, an even bigger impact in the equity markets. So if we look at this graph, over a longer time period, this is the S&P 500 since the recovery, since the recession, so a 5-year time frame. Each color segment shows you a different quantitative easing program. So we had QE1, QE2, QE3, Operation Twist, and the extension of all of those. And throughout all of those different programs of bond buying and mortgage buying, the market was moving higher, except for two time periods, and it's those in red, here and here. The market actually fell. Throughout this time period, this is the only time there was no quantitative easing policy in place. So you can see quantitative easing has a big impact on what's happening in the market. Now, one would hope that the Federal Reserve, they're following a well-established playbook and they know exactly what they're doing, when they're going to take the policy off, and what's going to happen to the market. But as you can see from this quote, it's from OECD Review Committee Chairman William White. He says that central banks have embarked upon one of the greatest economic experiments of our time. Now, I don't know about you, but that scares the heck out of me, because what it's telling you is there's no plan, there's no playbook, they have no idea what's going to happen. So, what this reminds me of, it reminds me of that old game show, Let's Make a Deal. Basically, there's 3 doors. Behind one of the door is something you want. Behind 2 of the other doors, you don't want so much. Now, Monty Hall, the difference with him is he makes you pick the doors. Tonight, we're going to use this as a framework to talk about what we see in the economy. So we're going to play a little bit of a Let's Make a Deal, but I'm going to show you what's behind all the doors right off the start.